I'm Mike Cruz, your host, private pilot, author of Saturday Every Day, and CEO of North Texas Wealth Management, a firm dedicated to values-based financial planning. Hey, thanks for tuning in for a third quarter market update for North Texas Wealth Management. And as you know, we have layers of investment research that we use, LPL's research team, as well as Morningstar Research and Helios Quantitative Research that provides the mathematical, technical layer of, investment decisions so we can stay data-driven. And I have a special guest today. The CEO, Chris Shuba of Helios Quantitative Research is with me. And I thought we'd just really have a conversation about exactly what all goes into behind the scenes, our portfolio management for our clients. So Chris, thanks for being here with me.
Thanks for having me. This is great.
Yeah, so, tell me a little bit about Helios and the expertise and the research team. You provide great value to advisors so they can help their clients and portfolio management and stay data-driven. But tell me a little bit about your team.
Sure. So we're the math nerds of the industry. So our job is really simple. We aggregate lots and lots of different data, and we use it to make what we call statistically relevant decisions. So investing is a very emotional thing, and when you apply not only the tough position that advisors are in, where not only are you managing money for other people, but you're also having to manage your own money, it can get really emotional, and we can sometimes start to make subjective or decisions that might feel really good in the moment, but aren't necessarily the best long-run decision. And so at Helios, our niche in the industry is to take in that mass amount of data, apply analytics to it so that when decisions have to get made, they have statistical backing to them. And just like everything in statistics, nothing's ever 100%, but it creates that consistent data-driven process, as you mentioned, that really creates that experience that we want over the long run. And so, we go through really easy times like, kind of leading up to COVID. We go through hard statistical times like COVID itself and the era post-COVID due to just the ever-changing data sets. But overall, we're thrilled to be kind of part of your process, and there's a lot going on these days, so I think we'll have a lot to talk about today.
Right. And your team, it consists of, chartered financial analysts, as well as, PhDs, mathematical models.
Correct.
And I'm really excited about the AI layers of, computational, layers that you're adding into the research. So I think, just like any business, you're constantly evolving and changing and looking at data and making it better. And I've been pretty excited about all the innovation. But, tell me, I guess, what do you see as kind of the future of Helios, and where do you see that going?
Absolutely. Well, you kind of nailed part of it there, and that is that, we've had plenty of AI and machine learning mathematics for a long time, but it's really been access to clean data sets and the technology to run them. And so over the last year or so, those have come into play, which has been awesome. And so we're in the process right now of enhancing our existing calculations that we think are pretty powerful in and of themselves, and adding more of that machine learning and AI on top of it to kind of push the envelope on what data analytics can do. And that's one of the really exciting things about Helios, is that most research firms, or certainly most asset managers, don't easily absorb new technology, new data, new methods, simply because of the nature of track records and how they work. But at Helios, because we're a research provider, we really don't have any of those barriers. And so we can be on as cutting edge as possible with the team that we have. And as you mentioned, yeah, absolutely, CFAs, PhDs, very experienced, folks in the industry, all part of our team. As far as the future goes, on the research side, that's part of it. But on the technology end of it, we're making a lot of investments in things that are related to taking a model or taking an investment decision and helping advisors bridge the gap between what would be individualized decisions and the host of complex decisions that actually bridge the financial plan to the total portfolio. So as we've always been involved in the models for individual accounts, our goal is to now push further into helping make sure that we increase the odds of the financial plan actually occurring, or increasing those statistical relevancies would be a way to say it. So a lot of cool things on our end as we continue on the research end, but also the technology side of our business.
Yeah, I think that's great. And, I describe, investment management as like a fine dining experience, right? You start with the ingredients matter. And so, the confidence ratings and the portfolio and kind of balancing risk return trade-offs. And then you look at building a portfolio or a model and having what we consider the right recipe, right? You got to put the ingredients in the right proportions to come out with something great. And then at the end of the day, the chef in the kitchen does make a difference in how you execute, and staying, diligent with the portfolio and executing on a consistent basis is really important, because you can have the right ingredients, right recipe, but that chef can burn it and ruin the whole thing, right? And
I might steal this. I might steal this analogy
right.
of yours. Right? I kind of like where you're going here.
And so, all three of those components, really matter. And Helios is a quantitative layer that we've used with really helping us stay diligent in that kind of belief and philosophy and process for our clients. And so, with that, I wanted to talk about, these elements. And, there's so much data out there, right? We can look at the jobs report and inflation and all of this. And so how do you, I kind of wanted to just educate our clients about how we boil that data down into elements that can be used to make portfolio changes and decisions that are forward-looking, not looking in the rearview mirror and saying, oh, we should have been here. It's how are we positioning the portfolio for the future? Can you talk to me a little bit about that structure?
Absolutely. So what we call an element, as you've used the word, is a aggregation of data. So we might have an economic element where we'll take in many, many hundreds of pieces of economic data and aggregate those together to determine the health of the overall economy. Now, when you do something like that, you're going to get a correlation between how healthy you think the economy is and then what actually happens in equity and fixed income markets, as an example. So it becomes a very useful tool in terms of taking in all that data, making that statistically relevant decision about what we think will be happening in the near-term future, right? And again, it's about a process that gets followed. So, over the course of the COVID era, we went through periods of really poor economic health, and then we went through periods of really nice economic health. And right now we're sitting at just slightly above healthy. So if you think about a score of 0 to 100, we would currently score the economy about a 60. And that's just slightly above the midline of a 50. And so that type of not only score helps y'all, make the decisions that are important to you in the context of your portfolio management, but it also gives you relevancy, relative to 0 or the 50-50 benchmark. How far away are we from good or bad? And as you might imagine, economic data does lag what the market does, but in general, there's a deep correlation between the health of equity markets and the health of the economic environment around it as well. So lots of good news there in terms of being above that 50 number. But that also stands in contrast to a lot of what you might see and hear on the news. Certainly 60 is not a great score. It's not 90 or 100, but it's certainly not a horrible score. And this type of calculation set has been, one of the reasons why Helios has been, one of the rare companies going back to last year saying, yes, we're going to be in for some tough times, but we're not seeing this Armageddon in the economy here in the middle part of 2023. And that's held true, not because of us having a crystal ball. It's just us following the math and being data driven. And the data hadn't showed us that we were at extreme risk of a collapse in the economy at that point in time. So it's one example of many, but hopefully that kind of adds some color to, the analysis that we're doing and delivering. So.
Right, and I think that's a great value, and the other part is that it's relative to a trend line, and so you can see, well, we're 60, where were we during different market cycles, and then you can look at that. Are we improving economically? Are we decreasing? What's happening with that score over time, and then where do we think that's going to go? And so it is very helpful to boil that down. And so the economy being a big component. I think that's the majority where the media and maybe clients focus is what's going on with the economy. But like you said, that can be a lag measure. And so some of the other elements that we follow that can be extremely valuable, like the contrarian element or value, based. Talk to me a little about each of these elements. We have, the contrarian. How is that structured?
Sure, yeah, we have a number of elements. We might run out of time today before we get to them all, but Contrarian is an interesting data set that we've been publishing for a while. And it's one of the more advanced because it's really hard to be a contrarian. A contrarian investor is normally going to do the opposite of what everyone else is doing. And so generally you'll find contrarian investors are really plugged into valuations. Is the market overvalued or is the market undervalued? And so we use a complex calculation that looks at things like price to earnings ratios as valuation metrics to say, okay, is the market fairly valued? And if it is, great. Let's go ahead and own a combination of stocks and bonds and be diversified. But as the market becomes more and more overvalued, then this element's going to pull back and create dry powder or invest more in safer assets so that when markets do fall, there is a risk mitigation effect and then the opportunity to buy in at a lower valuation. And the reverse is true. Once that loss has happened, then there's the opportunity to buy back in and allow for that excess return to accumulate as markets hopefully get back to near all-time highs or beyond. And so contrarian is like I said, it requires an advanced thinker to use that because zigging when everyone else is zagging is hard to do consistently, but at least it provides that formulaic data-driven backbone to say now would be the time to create that risk mitigation, or now would be that time to buy things at a discount. Again, nothing's perfect in this world, but it's a really nice measure for those that are contrarian minded.
Right. And then, the other elements being, really trend, looking at, momentum, things that kind of are going well, tend to keep going well, and the reverse can be true. And so looking at that as an element, and then also the volatility component. That one's probably the least understood from the surface. Can you talk to me a little bit about how that volatility element impacts fixed income decisions?
Sure. So the volatility element is a combination of looking at not only the equity markets and the expected amount of volatility that they might have over the coming months and quarters, but it also looks at the fixed income side of things. And there's actually two really interesting things that come out of trying to calculate expected volatility, and that is the health of corporate balance sheets as observed through things like credit spreads actually is a very good predictor of short-term volatility. So credit spreads essentially are the difference in interest rate that one company might pay above what the treasury rate is. So it's, the more interest you pay above the treasury rate, the riskier you are as a business. And as that spread or that difference gets bigger and bigger and bigger, it creates a lot of pressure on companies, especially mid and small cap companies and those that are on the lower tier of the large caps. And so that is a rippling effect when these companies don't have easy access to credit, because credit is the grease that makes the growth engine go. And so there is a high correlation between things like how credit spreads are behaving and how that impacts corporate balance sheets. In just the same way, when you look at other parts of this calculation, where we're looking at the actual options market and the implied volatility structures buried within them to talk about the equity markets themselves. And so we aggregate lots of data sets like this to get a handle on, well, how much risk is the market thinking is coming up pretty shortly? And using that to make a relevant decision. Is not a lot of risk expected, so therefore, let's be more comfortable with an equity position. Or if there's a lot of risk that's expected coming up, maybe we pull back a little bit. And again, try to soften the blow of sustained and deep volatility events. The reason it's the least understood is because these are pretty complex topics. I mean, everybody kind of understands economic data. Everybody kind of understands how trends work. But when you're really looking into, third order derivative calculations that are buried way within the data, that's why these elements get a little bit more complex. But it becomes a good tool for understanding how much risk the market is kind of pricing into itself without having that actual data be optically available for most folks. So it's complex.
No, I appreciate the insight there. And I think the key is that, what we do with our portfolios for our clients is stay very strategic long term, but realize there's some value in shifting that risk return profile when the data is, very obvious that it would be advantageous to do so. And so we use those elements to help drive those decisions so we can stay data-driven for our clients. But I wanted to kind of zoom out, look at the macroeconomy and just a few factors there. A lot going on. Of course, the attacks in Israel, tragic loss of human life. It's horrible. And I think, it's very evident that it has a very big impact in the global economy. And then, of course, the things that we're watching with interest rates, the potential recession, all of the Fed's decisions around that, but maybe because of oil prices, maybe a little bit of cooling off from an inflation standpoint. So what types of data are you watching right now to kind of judge the overall global economy?
Yeah, that's a great question. And I'll start off by saying that the whole game right now in the economy is what the Fed's doing, inflation, related interest rates, the economic data that we're seeing come through with jobs as an example. Those are the major, what we call causal data sets, meaning that what directly happens there has a direct effect on what you're seeing in your pocketbook, right? The global market behavior and a lot of the economy are following those causal data sets. We also happen to have a lot of non-causal data sets, and those are things that are certainly very interesting, most of the time disturbing, but they aren't directly responsible for market movements in the economy or things of that nature. So a great example of this is, as you mentioned, the now war in Israel and the war in Ukraine. While horrific human tragedies, at the same exact time, they're non-causal data sets, meaning they contribute to the aggregate world around them, but in and of themselves, when you go back and you look at geopolitical conflicts, they're a mixed bag. Sometimes we have market volatility around them, sometimes we don't. It's because they're not directly going to create something. Now, we will get certain short-term spikes in sectors, such as energy or food, when we have these regional geopolitical conflicts that we can consistently see. But in terms of a global macro rippling effect that creates an obvious trade, if you will, that doesn't come part and parcel with regional conflicts. Same exact thing when you talk about strikes, right? The UAW strike is something that's kind of ongoing, and even the individual companies that are affected by the strikes really don't exhibit much long-term pain because, generally speaking, strikes are fairly short, and companies and the workers generally end up in a better spot. So we don't see a lot of selling activity right around the actual strike because it's kind of a non-event over the long run. There's not a trading activity there. And I could go on and on about these non-causal events. Another great one is government shutdowns. It's a contributing event, but it isn't something that in and of itself is driving a obvious long-run sustained volatility event. You could, with government shutdowns, kind of sell in the few days before and buy in the few days after and maybe make a little bit of money if you leveraged. But in terms of a long-run strategic investor like the vast majority of investors are, it's really an event that you wouldn't even think about because it comes and goes so fast. So a lot of non-causal events are trickling around the headlines, but the main meat and potatoes causal events right now are the Fed, inflation, the same story we've been talking about for 3 years. That's still the meat and potatoes.
Very good. Well, one last question. I appreciate we got pretty technical, and I think it's valuable, I would say, to pull back the curtain and talk about the details. But, I'm sure that, my clients at home are watching this and saying, okay, so where are we headed through the end of the year, and kind of just the overall sentiment. And I think, the snapshot is it's like, are we going to have a soft landing? And I think the data suggests that we will. Can you just speak to kind of that overall outlook and sentiment?
Well, you did invite a math nerd to your podcast, so of course it's going to get a little technical, I guess. But yeah, I mean, right now when we look at the data that the National Bureau of Economic Research publishes out and says, hey, here's the type of stuff that we're judging whether or not we're in a recession on. There's 6 major data points, and all 6 of those are positive right now, which means we're not in a recession according to that calculation. And it would take quite a bit of economic movement for us to move into a recession at this point. So I do think that a soft landing is still on the table. There's any number of shoes that can drop at this point that would make that not the case, and the biggest shoe would be jobs. So as long as the jobs miracle keeps happening, then it's hard for us to get a deep recessionary environment. We might get a mild recessionary environment. We might get a stagnant economy for a while. But in terms of this severe collapse in the economy, like some people predicted at the end of last year that would happen in the middle part of this year, the data just isn't bearing that out at the moment. But being data-driven means we're going to take in new data every month. We're going to see where that's taking us. And if that statistical relevancy starts to point towards, more pain than expected, then that data can be shared, right? And we can make decisions based upon it. But at the end of the day, right now, the data looks strong enough where if we were to get a recession to start to form, it would likely be more mild. As long as jobs hold. So if there's one thing you're looking to keep track of, keep looking at that jobs number, but also look one layer deeper. Look at wage growth. Look at productivity. Productivity and wage growth are kind of sub-data sets of jobs, and those are where the problems are right now. We're not getting the real wage growth that we need. That's actually kind of good because it will end up potentially helping the inflation number come down, but that has a drawback of people pulling back on spending in total, which is then harmful to the economy. So wage growth is concerning right now, and productivity is a little bit concerning because, again, it doesn't matter how many people you have, and it matters how much that collective produces. And that's been a concern for a little while. So definitely keep your eye on jobs. That's going to be the main signal here, at least so far, and we'll see where the data takes us at that point.
All right. Well, hey, Chris, I really appreciate your time shedding light on that. And, hopefully for those of you tuning in, you found the conversation valuable and probably a little bit more optimistic than what you're reading in the media. So thanks again. Thanks for being a client. We appreciate your trust and look forward to continuing to serve you.